Welcome everyone for this final session for the day. Today we're going to, out of this session rather, we're trying to bring it all together in terms of pitching some use cases for ETFs, index tracking products within your portfolio, and how that all comes together, and you can actually practically put this to use within your portfolios. And I guess firstly, before we get into the crux of it, I'd just like to firstly thank our wonderful guests for being here. I know you guys bent over backwards and really made the time for us despite your busy schedules. And let's start, Nerina Visser. So should I just say ETF guru for South Africa, but ETF strategist, independent strategist at etfSA, should I say?
Correct.
And we've got Melissa Dyer with us as well, who is the Senior Wealth Manager at Harbour Wealth.
Yes.
Melissa, welcome. Hope you're feeling strong after your big night yesterday.
I'm going to pull it together.
Okay. Cool, fantastic. But judging from your profile picture, I'm not sure if you saw the invite as yet, but geez, you've got some skills there, even on the catwalk, eh?
Gee whiz, I'm excited to see what photo you used.
That's quite a nice little pose. I must actually try that at some point. Yeah, well done. But let me give you a little bit of a rest in case you need it from last night. But Nerina, maybe let's kick off with you, and let's start with some foundations. And let's get some of the acronyms right firstly. There's a lot in the market. There's ETPs, ETFs, AMCs, AM ETFs, UTs, starting to sound like a hip hop song here. But maybe you can unpack that for our audience. How, when they see these acronyms, what do they mean? What are the differences between them?
Thanks, Ryan. Yes, I think it's worthwhile maybe to start with ETP, Exchange Traded Product. And I think it follows on very nicely from your previous session in terms of the listed environment, the stock exchange, because I think the key thing that ties together most of those acronyms that you mentioned is the fact that they are exchange traded. You buy them on the exchange. So this is about access. Where do I actually get to these investment products? So probably the best known, and which has been around the longest in South Africa, ETFs, exchange traded funds. Probably a slightly lesser known version that came after that was ETNs, exchange traded notes. We then got AMCs, actively managed certificates, and most recently AM ETFs. We came full circle to actively managed ETFs. Before we go to UT or Unit Trust or CIS, Collective Investment Schemes, let's maybe focus on those four major exchange traded products that we've got. And I like to think of this along two dimensions. The one dimension is, what is the underlying asset structure? What is it that I'm actually buying? And that is where the F, the exchange traded fund, or the AM ETF, the actively managed exchange traded fund, becomes very important. Underlying that investment is a physical asset pool that belongs to the investor. So that's really important. Similar
regulations as well.
Exactly, as the UT that we're going to come to in a bit. So absolutely, you are buying a fund in this perspective, a physically backed asset. The ETNs and the AMCs, the actively managed certificates, the underlying there is actually effectively a balance sheet, a promissory note. This is typically issued by a bank off their balance sheet, and what they give the investor is a promise to deliver the performance of whatever the reference asset is that we are talking about. So that's the first dimension of differentiation.
Credit risk, a promise from the issuer.
Exactly. So am I buying something which is physically backed and actually belongs to me as the investor, or am I buying a promise from a bank, comes with some credit risk as well? That's the first differentiation. The other dimension in which we differentiate then is, what is the investment style underlying these things? So first generation ETFs were very much index tracking products. And we'll go into some detail in terms of what does index tracking actually mean. The horrible colloquial term, which I really don't like, is passive, but effectively an index tracking product follows a predefined set of rules. And so whether we are looking at an ETF or an ETN, that's the common feature that they have. They track an index. They follow a predefined set of rules. The second differentiation is then actively managed. So whether we are looking at an actively managed ETF or an actively managed certificate, the underlying style of investment says, as the name says, actively managed. So I think it's quite useful understanding those two dimensions of differentiation when it comes to those four ETPs, exchange traded products.
No, thank you. That's very clear. Maybe if we can touch on that part about defining what an ETF or rather beg your pardon, an index is.
Yes.
Now, is it still, or has it come quite a long way from an index being a benchmark that people refer to from performance perspective, or is it means a lot more to the world in this day and age?
Yeah. Ryan, a great question, because yes, we've absolutely seen that evolution. When indices were first introduced, and we can even move beyond our investment sort of indices, things in terms of things like the inflation index, consumer price index, there's an index in that, the house price index. Indices are things that really just give you an aggregate calculation of a group of things. So in the context of investments, investment indices certainly started out as benchmark indices. The idea was really a single gauge that can tell you what was the performance of a particular group of investments. So the all-share index, as the name suggests. It's all the shares that are listed on the JSE, and it tells you what is the aggregate performance of all of those shares in the index. But what we found over time is that the first sort of generation of index tracking products then use these benchmark indices as allocation guidelines. So I want to differentiate here between the roles of what you would use an index for. The benchmark index really just represents, that's what the average sort of performance of the market is. That doesn't mean to say that that is necessarily a good guideline for how you should be investing assets. And so some of the early actively managed sort of the value proposition was exactly to do something different than just what this sort of bland benchmark index would do. But the evolution of indices over time saw them starting to fulfill a much more specific role in terms of allocation guidelines, rules that basically say, and I'm going to use an example
of rules to construct a portfolio.
Exactly. Let's think of maybe one of the sort of classic rules that an active manager would follow that says, I'm a dividend-based investor, I'm a value investor, I'm going to invest in the companies that offer me the highest dividend yield. That becomes a rule that can say, okay, well, the index can now go and select the companies that pay the highest dividend, put them together in an index, which becomes the allocation guideline for the index tracking product. And so now your index is something very different than that benchmark index, the thing that really just sort of measured the overall average performance of a market or a sector or an asset class.
And I guess that's to your point earlier about it not being passive anymore.
Exactly.
And not liking that word. It's actually a very active decision on what exposure you choose to select.
Right, spot on. And it's actually an active decision in two ways. The index rules itself have become a lot more active in the sense of how do we define those rules. But probably the most active of all of it is for the investor to decide which of these many indices and index products am I going to select to use in my investments. So even though the underlying investment premise might be so-called passive, tracking an index, your choice of which index or combination of indices you want to track is a very active decision.
And at what time that you're investing and disinvesting from them. No, for sure.
Yeah.
Fantastic. Mel, I see you trying to step in here. So
I'm ready to go. I'm well rested. I'm good to go. Got lots to give.
So Mel, maybe just some scope sitting from your side. What are your client base? What types of clients they are? How do they get bucketed in? What sort of process do you follow for them? Is it very much goals-based type investing, long-term driver of returns, structuring long-term portfolios for retirement? Maybe give us a flavor of that there. How do you think about your client base?
So Ryan, at Harbour, when we started Harbour Wealth, it's nearly 13 years ago, you're not 25 anymore, the whole concept of the business was to provide good advice, quality advice, to as many people as we could reach. And what we then did is we set together our best investment view, both locally and offshore, because we want our clients to be invested in our best investment thinking at all times. You shouldn't get my 47th best stock pick. Yeah. You shouldn't be invested where I'm investing my mom and my clients. So we have those kind of guiding frameworks in both local and offshore, so in rand and dollar based. And then along with those, it changes, and each client has their own unique asset allocation depending on cash flow. So everything you do is around structuring cash flow for clients. When do you need to access capital? That's the biggest question I need to understand. Because we all know in the markets, there is a chance of losing capital over the short term. Volatility is high. We're living in it right now with Trump. It's making our lives nice and busy. But the longer you remain invested, that volatility falls. So I want to, and we want to be able to provide our clients with access to growth assets, because that money needs to be there to be able to provide an income either at retirement, at death for your beneficiaries, if you become disabled, etc. So the way that we structured it, we're all economists by background, was getting the big calls right. Don't waste your time on the stock selection. That's not a skill set either. It's around asset allocation and deciding, back to Nerina's point, do you want to be offshore equity or local? Do you want to be in Japan or India? Do you want to be in a certain sector in financials or not? And not passive, I must be careful there. And index play for us is a clean and efficient entrance into that space. So we've got our strategic asset allocation bands. We play tactical tilts along the way, following our investment committee meetings quarterly. But then the easiest and most effective way of implementing those views is using index building blocks. So we do a building block approach, and that's where we use, Ryan, as you know, a lot of your funds in that space. Offshore, we've also been able to use a lot more ETFs because the pricing is better. I know it's getting better and better every year as those markets deepen and widen. But for us, obviously, on the client side and advice side, fees are important. Because remember, we're trying to keep that bucket compounding and growing to retirement. And if there's holes out the bucket, it hurts the performance. Fees also compound over time. And if you can get an index tracking fund that says what it does in the box, it costs a fifth of the price, and it wins 95% of the time through the SPIVA reports, which we follow, it does, offshore 100% of the time in the equity space, then use it. In the fixed interest space, in the cash space, that's where we have two wide ranges for our clients. A blended range, which is half index, half active, and then one pure index range, which is as much passive as we can, but still in there, our cash and fixed interest block is actively managed. There's just too many levers to pull that right now we can't get access to quick enough in that space. On the duration curve, corporate credit, etc. So we use active managers in that space. And again, back to the SPIVA report, it's shown that active managers in that space win 70% of the time over the last 10 years. So that's the way we construct the portfolios. And then it's all guided by when does the client need access to those funds. So if it's a 1 to 2 year space, pure income, no equity exposure. Years 3 to 4, we actually half in. So in our conservative portfolios, 50 in, 50 out. Balanced, if you're with me, is years 5 to 6, so that's 75 in, 25 out. And growth is 8-year plus money. So this is where we are going to implement our best investment views for long-term capital appreciation. And every client, depending on their cash flows, because remember, it may be a car at this stage, a son going to university at that stage, an overseas trip then, everyone's got a different and unique asset allocation that meets the cash flow requirements.
Geez, you guys are really making my job easy today. All of the key points are just coming out so naturally. And Mel, I mean, you've touched on quite a few things there that's very important. I just wanted to highlight it here for our audience. So firstly, I mean, you clearly see value in not spending time attributing a single stock performance, analyzing as a stock, as you're saying, but rather the asset allocation drives the majority of the returns. And that's where you rather spend your time where you're getting best bang for buck. And whatever time you've got left, spend with your clients and providing value face-to-face, spending time with them and meeting their needs, I guess, is probably a lot more valuable than, as I said, trying to analyze a stock and attribute a performance to a single stock.
Ryan, you're completely right. When you sit with the client, and Nerina, I know you also have direct clients too that you look after, you're not talking about this kind of stuff. He doesn't really know where he's invested and what the NASPA's price did today. He wants to know, have I got enough when I get to retirement? If I pass away, have you taken care of my wife and kids? If I become disabled, I don't want to be a burden on anyone else. And if I lose my job tomorrow, am I okay? And once you meet those needs and you empower and educate, they're part of the journey with you. They're co-creating their financial plan with you. They buy in. And it's the big picture stuff that is the most important. It's about understanding the client needs and wants, understanding what that money's there for. You know, if he's got more than enough, maybe there's a legacy, maybe there's a good succession plan. So you're completely right. By outsourcing kind of those areas that take up a lot of time and create a hang of a lot of noise in the market.
And for not the value.
Correct. Focus on the really important things in your client engagements.
Now, for example, like you mentioned, with what Trump is causing in the markets and all the volatility, we still had our markets reaching record highs in South Africa. So if you didn't spend the time on proper portfolio construction and good asset allocation, you would have missed out on the big SA market rally for this first part of the year.
Well, right, and that's it. You go back and, you know, some clients get upset with the noise, and we understand it. I mean, it's going to be fun to watch how this goes in terms of inflation and growth. But the biggest question, again, is to ask, thanks for the call, but tell me, has anything changed? Do you need access to funds sooner? Has your income requirement changed? No? Well, then we've got you. Your portfolio is optimized to take care of these dips in volatility. And in fact, they create more opportunities, right? Things are easier to get in sometimes when they've pulled back than buying in at all-time highs all the time.
Yeah.
That's fantastic. And maybe just the last point to highlight before we move on is around fees. Like you mentioned, that compound saving on fees. I've seen some numbers out there, and I mean, we can run the math ourselves as well. But I saw a number that if you look at someone's investment horizon to retirement, so let's call it a 40-year period, and if you just invested 10,000 Rand and just growing that at inflation, but saving that 2% difference on fees, it makes a difference of 380,000 Rand versus 700 at the end of that period. Yeah. I mean, it's astronomical, the compounding effect of that, of saving on this fee. So that's very, very valuable.
And Ryan, if you look forward to retirement as well, there's so much literature and noise around your drawdown rates, for example, in retirement. But what advisors often miss, and clients too, is when they're talking about their drawdown rate, they're not looking at the actual drawdown, as in add your fees back in. Understand who you're paying with your retirement funds that you've worked hard your whole life to accumulate. And if you can keep those fees down, listen, there's definitely fees, there's value to be had by having an advisor, by using this active process and the ongoing loop, the feedback loop, etc. But you can do it much more efficiently and let your money work for you. You worked hard for it.
Yeah. And maybe lastly on that point as well, there will always be space for both active and index tracking products. In fact, the more index tracking products starts to take up in our market, it makes it easier to choose that active manager. It weeds out the rest. It makes it easy to choose that active manager that stands out, who's consistently outperforming the benchmark. And as you said, there's certain asset classes where it makes sense to, and you blend those together for the best outcome.
Yeah. Ryan, as far as I'm concerned, all investing is active. It's how you implement the appropriately designed active strategy in the most efficient way, and cost efficiency is very important, but I love the term that you used, clean, when it comes to index tracking products, that transparency, that certainty with what is the actual exposure that I am getting through this fund in which I'm investing. And if you've got a good advisor that is following a proper process in terms of designing an asset allocation that is fit for purpose for the individual client, implementing that through one composite actively managed unit trust is not the answer, because you don't know what's sitting inside that. Remember, most of your unit trust information is only available way after the fact. As I sit here today, I don't know what is in an actively managed balanced fund portfolio unit trust that I invest in on behalf of my client. So how can I know that when my client calls in a panic, that I can give him the assurance that, you know what, you're okay, because your underlying exposure that you've got in your portfolio is still fit for purpose. And it is that level of transparency that I think significantly empowers the advisor to have an active process with a client that is fit for purpose, rather than spending time on actively trying to select the granular detail of underlying components of a well-defined investment strategy.
So, Nerina, thanks. So let's stick with that. So we've touched on the benefits of including index tracking products in your active decision to construct a portfolio. So we spoke about fees, we spoke about transparency. Is there anything else that comes to mind
Yeah.
on the benefits of
I want to
including or
follow-
blending these
Yeah.
in your overall building block solution.
I want to build on what Mel had said in terms of certain types of asset classes and certain types of exposures certainly lend themselves better to vanilla index tracking. Let's put it that way. So I think probably the most obvious one is US equities. You find me the manager that can consistently over time outperform the S&P 500 index, and
Put
you're
your
not going to
house
find it. I said consistently, and with almost advanced predictability.
Yes.
That is a market that is so highly efficient in terms of how it's done. The cost efficiency of that type of index product also just makes it a no-brainer in terms of that type of
that
exposure.
manager could be doing ends up becoming traded out in time, and then how do you know when to switch to a new manager and when not?
Exactly. Then we have other types of asset classes where the vanilla indices that are available are not nearly as compelling. And I think you mentioned fixed interest, and I think in particular, if we think just of the South African bond market, for example, our fixed interest indices, whether we look at, say, the All Bond Index or even the Government Bond Index, my problem that I often have with fixed interest indices, let's think just in terms of the construct of equity indices, market cap weighted. The bigger the company, the bigger it's holding in the index tracking fund, in a vanilla index tracking fund. On the bond side,
one pricing point, at the end of the day, there's an auction, you know exactly where it's marked at the end of the day.
Now you get to the bond market. How is a bond index traditionally weighted? On issue size. In other words, the more indebted the organization that issues the bonds, the bigger the weight that you have in your index. And it's like, I'm not quite sure that that's necessarily the best way to construct an index for asset allocation purposes, almost investment allocation purposes. So the fixed interest space is one where we see a lot of benefit for actively managed strategies. But what is now great about this sort of evolution of the actively managed products or the exchange traded products on the JSE is that we now have a much broader range of actively managed ETFs, so still that unit trust, that safe underlying fund, but an actively managed strategy in the fixed interest space, in the bond space. And now you can sort of pay attention to what is the objective of that particular fund. And some of them you will find the objective is, for example, to never lose capital over a rolling 3-month period. Now, that's something I can work with in terms of matching it to a client need. Or it might be that you are looking specifically for yield pickup by investing in corporate bonds, something which is not readily liquid available for a traditional index tracking product. But here's great opportunity where you can actually get that exposure still through an ETF, but it's an actively managed ETF. For me, that is the best of both worlds in terms of the benefits that it comes to it. So as a portfolio constructor, as a financial advisor who constructs a portfolio fit for purpose for my client, what is key for me here is understanding the different asset classes and components of the asset classes, understanding where pure vanilla, simple, low cost is the optimal way of doing it, and where do I need to go for enhancement, active management, specific types of styles of exposures. And then I love the safeguard of the fund structure, the CIS structure that sits in the actively managed ETF or the actively managed certificate even in terms of it. And then I think, well, now I can actively select on a very different range of criteria than, is Standard Bank a better option than Nedbank? For me, the value add lies at almost that product and exposure active selection rather than on the individual securities within a particular asset class.
And are you comfortable at the moment we've got a wide enough range for you to dip your toes in many things with JSE?
So we've certainly seen an explosion, not just in the number of products in the space. In fact, we are now, I think, as of this week, we've reached the point where there are now more exchange-traded products listed on the JSE than individual shares.
Wow.
Yes, we are there. Fast approaching 300 in terms of the exchange-traded products. So in terms of number, we've seen an explosion in what's available. In terms of the range of what's available, we've seen an explosion. What I am still looking more for is what Mel also alluded to in terms of the goals-based investing, outcomes-based investing, products that are designed and developed around delivering on a client objective, an outcome that needs to be defined, rather than on the more traditional way of thinking about indices, portfolio construction. We like to think of it from the client's perspective rather than from the product provider perspective.
Well, perhaps there's an idea there of entering the actively managed ETF market, goals-based.
It could be exciting. I mean, you have seen quite a few fixed interest players doing that. Exactly. I mean, they're there. Yeah. So they definitely, they're trying to meet that need. But Nerina, I'm with you. In terms of, if I just look at our portfolios offshore, kind of what we're allowed to choose from. You know, you can have a theme, you can have a sector, you can have pretty much anything that you think is
strategy.
Correct. Where locally it's getting there, but we're still not there yet. But it's great to hear the progress we're making though.
Definitely.
And I guess with that breadth comes a decision of where do you best use your risk budget that you may have for your client as well.
Yes.
Should I, instead of, do I get more bang for buck putting in together an index tracking product with infrastructure, something uncorrelated, but up getting a big alpha profile from that small part of that small allocation without adding any further risk to my overall portfolio. And to your point, Nerina, the more we have of that, I guess the better it makes more helpful, more sense for investors as well.
Yeah. So note to product providers, we're not looking for more S&P 500 ETFs. We want to see product that actually talks to client needs in terms of the objectives.
Okay, cool. Mel, anything else that you think's worth highlighting?
Well, I actually wanted to bring through what Nerina mentioned as well about not using the word passive anymore, because we've seen it. As advisors, you pick up clients who invested passively because it was the kind of buzzword 10 years ago, and they thought that it was okay just buying one or two index trackers, but you didn't have the active management. And that's a big gap, because what was right 10 years ago over time does change. There are certain cyclicalities that you want to take care of, structural changes when they happen. And if you don't have that active overlay, whether it's at a portfolio manager level or an advisor level, your portfolios aren't aligned to meeting your needs. Maybe they were 10 years ago and you patted yourself on the back, tick the box, but you need that ongoing active management. That's where you add the difference. And that's also where you engage the client. They're along the journey with you. They're understanding what you're thinking. They're understanding what you're implementing. And that, creates a lot more longevity and trust than just sitting back, big black hole, oh goodness, leave it to you.
And I guess to both your points, we may have more, if you have more of those individual products coming to the market, like a Bitcoin ETF. I mean, it all sounds good and well, but nobody's going to take all of their money and put it into that. You still need someone to construct that portfolio and have that active overlay, to your point there, Mel, over this. And how do you utilize these various products within your portfolio?
Yeah. Ryan, I would like to maybe just expand a little bit more on this context or this concept of active management.
Please,
and especially when we look at it in the context of the actively managed ETFs as we have it available on the JSE. When you hear the term active management, you tend to think of, there's a lot of activity going on in there. There's a lot of strong positive or negative positions that's being taken on. But we need to understand that the rules on the JSE is such that when you have an index tracking product, which is what the original sort of ETFs were all about, those are some very strict rules in terms of tracking error. You're not allowed to move away from that index. In fact, full replication is what is required, meaning that you've got to own all the shares in that index in exactly the same proportions. Actively managed allows for breaking of those shackles. So we also see some actively managed ETF products that operate on a fairly rules-based basis. In the multi-asset portfolios, for example, following a strategic asset allocation. But because we don't have multi-asset benchmark indices, there is no index to track, and therefore you cannot offer it as an index tracking product. So just because something says actively managed on the box doesn't necessarily mean that the underlying is as actively managed as you might think it is. So what does that mean for the investor, for the advisor who uses these products? It does mean you need to do your homework. You need to understand what is the underlying, what is the strategy, what is the objective, not only look at past performance. That's another one of my bugbears, along with passive, the term passive. But look at the construct, the objective, because that's where you're going to find the right match to your client needs and objectives. So don't just assume because it says AM on the box, as in actively managed, that it is what you might think actively managed is. Yes. And I think that breaking of the shackles of moving away from pure index tracking replication, I think has opened up a significant opportunity set beyond what we traditionally had as ETFs, without having to go full-on active, balls to the wall, if I can call it that, taking on big, risky positions. There is a whole sort of spectrum, risk spectrum, in terms of underlying investment styles. And it's really up to the investor, to the advisor who chooses those investments, to make sure that you know what you're getting into, and that it suits your needs, that it serves the purpose, the goal, the objective that you've got for your investment portfolio.
Fantastic points, Nerina. Very fantastic points. So Mel, maybe can I dare ask, where do you see the rest of this year going? Or you like, doesn't matter, my portfolio is constructed to ride out the storm and focus on the long term? Or do you guys have some house views for the rest of
we do, right? So we, as I said, we do have our investment committee meetings at least quarterly, where the investment team goes, and puts together a lot of consolidating a lot of the trends, the themes that are coming out and playing out. And you can't avoid it, right? For two things. Firstly, you need to be informed to have those conversations with your clients. It's no use you getting there and you have no idea what Trump's doing or what the overlay or ramifications are in the markets, etc. You need to know what's going on, but you also need to control the noise. Yep. So it's all very well to know that, and at least if you have a client engagement, you can give them the information. You can say, great point, we actually discussed this as a team. Here's the pros, here's the cons, this is why we're doing what we're doing. Because 9 times out of 10, you hold your line, you stay the course. Again,
which is important in having a framework and a set
Correct.
of rules to manage the portfolio.
Correct, but every now and then there are opportunities that arise. So right now there are some. Offshore, again, because we can play in a lot more different themes, we're looking at broadening kind of the enabling space around AI. We've looked at also trimming a bit of profit out of China. So there are some movements we've taken, but the US is still too big to ignore. You may think valuations are high, which they are, but relative to what? It's not, there's always two sides. You can't just sell out. Where are you going? Interest rates have come down. So there's an opportunity cost of cashing out and sitting on the sidelines. You then also introduce timing costs. Well, Mr. Client, I'm so good because I sold you out and I avoided the dip. When am I buying back in? Because I'm never going to get that right. So you can create a lot of distraction by jumping and moving with noise. But you need to know what's going on. And obviously, as I said, we are taking small tactical tilts, but we are, for clients, again, simple questions. Have your needs changed? Do you need access to capital? If not, don't worry, we got you. If that is, obviously we need to reassess. I always find there's a bit more leeway with new money coming into the market. So there we are looking at some alternative products. Structured products we do use a lot in our business for small portions, again, of select client portfolios where maybe some elements of capital protection are warranted right now, maybe some gearing if you think we're going to be a bit range bound going forwards. So we are
there's less liquidity needs because those
Correct.
Products are generally tied up for a term.
They are, yeah, 3.5 to 5 years. So we are looking at a few of those, and they're quite enticing as well. Sometimes when you're looking at the pricing, and again, they're meeting the client need because I know what's going to be delivered in 3.5 or 5 years' time. Makes my planning and reporting forward much easier to do. So that's in terms of the markets and what we're thinking.
Anything new happening in the business that you can share?
Yes.
Where are you guys going with it this year?
In the business side, we are really, really embracing and spending a hell of a lot of money on tech. So the tech side, again, to keep efficiencies in the business, but also...
But it first comes at a cost.
It does. It does come at a cost. And again, you have to... It's not a one-stop shop. You have to carry on iterating and moving forwards. Our tech we're trying to do is, again, simplify, put the power and education back in the client's hands. So it's simple again. The client's going to be able to see all day, every day, his 4 scenarios that I ran through earlier around when I retire, pass away, disabled, or resign tomorrow. And everything's feeding through and showing them kind of what their accumulated capital will look like, and what does that mean in a monthly income term discounted to today's rate, because clients will always say, but what will I be able to buy with that? What's medical aid inflation going to be, education inflation? You say, no, we've discounted it back. This is in purchasing power today. So we've spent a lot on that, and obviously refining and building on that. In terms of the team as well, we've also spent a lot of time re-looking our vision and our culture, because that's where you create trust, that's where you create brand in the market. You know, everyone's got to buy into why we do what we do. And everything at Harbour Wealth is guided by 2 words, guys, and I know it sounds simple, but it is. It's better outcomes. You sit in a meeting, it doesn't matter who's involved. Is what we're discussing going to result in a better outcome for the client? Yes? Cool, let's go. Let's keep building on that. Let's work on it. No? Stop, shelve it, it's done. So that's been a wonderful kind of, I suppose, a re-energizing and a refocus again for our business.
And I guess your use of tech speaks to the point around, or rather the worry where AI tech is going to take over jobs, but actually the human and tech together provides a better outcome than they could have done individually for the client.
Ryan, outsource the stuff that takes up your time and that the AI can do much better than you and much quicker. It again frees me up to have those conversations with the clients around structuring, around their needs. Have we thought about offshore? Let's look at the tax jurisdictions. That's where we add our value on the client side, on the relationship side. You can outsource a hang of a lot in the AI space, and that will only get better. Portfolio optimization, asset allocation, that's going to get better and better as those AI functionality develops.
Thank you, Mel. Nerina, if I give you the closing comments, what's new, what's happening in your business?
Yeah.
What are you guys looking forward to for the rest of the year?
So I think let's maybe start with sort of the portfolio positioning, the investment sort of premise. We follow what we refer to as a core and explore portfolio construction model, where the core of a portfolio typically would be a multi-asset balanced fund portfolio fit for purpose for the client. So the proportion of growth versus income assets, the proportion of local or global, that would be based on the client's needs. The size of that core depends also on the risk profile, the time horizon of the client. So if you've got a client with a relatively low risk profile or a relatively short time horizon, that core is going to be a substantial part of the portfolio and the Explorer is going to be small. As you extend your time horizon, as the risk profile increases, the core can be a smaller part and the Explore then becomes a bigger potential option. So in the Explore part, I'm just going to focus on 3 sort of current themes that we're looking at. We are certainly of the view that there is a broadening of market opportunities taking place away. Maybe I shouldn't just say away from the exceptionalism of the US equities over the last 10 to 15 years, but a broadening of that, because I fully agree that strong AI US theme will continue, but it's no longer the only game in town. And so there's opportunity for us to broaden first into a size spectrum, so moving maybe into mid and small caps in the US. The second one is within developed markets to say, but there's a world beyond the US, and within the context of the rest of developed markets. So, is it UK, is it EU, Canada, whatever? Our preference at the moment is for Japan. We feel that Japan actually is somewhat counter-cyclical, offers much better valuation opportunities at the moment than many of the other developed markets. And from a policy sort of sensitivity perspective, they seem to be one of the least exposed to Trump's policy uncertainties that we have at the moment. The second part of broadening then is into the emerging markets, and there we are also quite selective in terms of specifically focusing on emerging markets in Asia. There we've seen a period where India did exceptionally well, China was a laggard. More recently, India's come off the boil, China sort of built up. Within the One Invest Emerging Market Asia ETF, we've got that wonderful opportunity to have that counterbalancing argument that we actually not only have China and India, but we also have Taiwan, we also have Korea. So that's how we would almost implement our view of a broadening of the market. Emerging markets as a group have underperformed developed markets for an extended period of time. That type of relative disconnect reverses at some point. So again, when my client has got a long enough time horizon, I'm going to proactively position him towards that area away from where the past performance has been. And then the third theme for us that is really important is the diversification from an asset class perspective to incorporate more real assets, more counter-cyclical assets into portfolios. We've seen incredible performance from gold, and of course gold you can implement as buying into physical gold or into gold mining companies, and we do both of those, but even slightly broader than that, precious metals as well. So looking at the likes of your platinum, for example. Another form of real asset, because we'd love to think in terms of things like maybe some of the private equity, but those are not as easily accessible in private client portfolios, but certainly things like property. Property has been the dog for the longest period of time as interest rates have started to moderate that focus in terms of real assets, something counter-cyclical. Bear in mind, listed property nowadays also is no longer just bricks and mortar.
Yeah.
We're talking fiber installations, cell phone towers, data centers, all of that sort of thing. So we see that as a really interesting spectrum. And I think my final sort of view in terms of that is, what is Trump long before he is the president of America? He's a property tycoon. He's not going to do anything that is going to hurt his primary business, which is property. So that's my sort of my little chip on red that I put on the table.
Thanks a lot, guys. I think I'm gonna call it a wrap there. I think I'm probably well over time, but there was no way I was stopping this train. There's just too many valuable insights from you guys. And again, a sincere thank you for making the time with us today. So guys, I think let's call it over there. Thanks for joining us. Thanks for spending all of this time with us, and looking forward to many, many more of these.